We are all here today for the COVID-19 recovery series. We are going to be talking about PPP loan forgiveness, and we've got some great panelists here to walk us through how to make sure that we get those loans forgiven successfully. So first and foremost, I always like to start out with thanking our sponsors. Thank you to everybody that's on this screen. Without their support, Tight Oregon would not be possible. So if you are looking for accountants, financial services, lawyers, a place to work, please take note of the individuals or the companies that are on this screen. Again, they support us, so we would hope that you would please take note and support them as well. This webinar is being recorded today. We have 3 folks that will walk through brief presentations, and then we're going to open it up to Q&A. Please put all of your questions in the chat box. And again, at the end of the presentations, we will go through as many questions as we can. But please also recognize that this, again, will be recorded and available on our website for future viewing. So without further ado, I'm going to turn it right over to our panelists. We've got 3 individuals here from Moss Adams, Scott Lieback, Jesse Ulrich, and Mike Cullum. And I'm going to first turn it off to Jessie, and she will take it from here. Thanks, everybody.
Thank you. We're excited to be here today with you all. You'll be hearing from the 3 of us. As mentioned, Mike Cullum is a director in our national national office, and he's been doing a lot of work on the PPP loan process and has been presenting on this issue many times already and many more to come, we're sure. Next, you'll hear from Scott Lieback, who is a senior manager in our assurance practice. And then I'll wrap us up talking on sort of the tax implications of the PPP loan forgiveness process. And both Scott and myself sit in the Portland office of Moss Adams. So I'll pass it over to Mike and we'll get started.
Thanks, Jesse, and welcome everyone. I just, hang on one second while I try to share my screen. Can everyone see that?
Yes, we can.
Okay, terrific. We're going to start with an update on the Payroll Protection Program. As you know, or probably know, especially the borrowers, this has been quite a journey since this CARES Act was passed in March. And my screen isn't moving. Let's see if I can, there, I'll just use that. Just before we get started, a little bit about Moss Adams. Moss Adams is a fully integrated professional services firm. We provide audit, assurance, tax, consulting. We have a registered broker-dealer that does transactions. We're in almost 30 offices, basically located west of the Mississippi to the Pacific Ocean. We have nearly 3,500 staff. We have clients in all 50 states, as well as China and Canada. To appease our lawyers, I need to say this, the material presented today is for informational purposes only. To the extent that you need advice or professional services, please reach out to us or our trusted advisor. And when it comes to PPP, it would not surprise me if you needed help. Let's go through the PPP program. First, a quick status update. August 8th was the final date for loan approvals in the program, at least for now, until Congress makes some changes. As of August 8th, there were 5.2 million PPP loans issued. A little more than 2/3 of those were for amounts less than $50,000. The average loan size was just over $100,000. And now, as of August 8th, there was still $134 billion with a B remaining undeployed from the program. You should also know that a number of lenders have still not opened their portals to start accepting forgiveness applications. And for that is happening for a variety of reasons. On June 5th, Congress passed the PPP Flexibility Act. It was basically an upgrade to the original CARES legislation. There are a number of things that they did were very positive for borrowers. I'll go through a few of those here. The covered period was increased from 8 weeks to 24 weeks. Now, you might remember that the loan that you received was based on 2.5 months of payroll activity from 2019. So now, during 2020, during the covered period, you have 24 weeks to spend correctly amounts that were based on just payroll for essentially 10 weeks from 2019. So that was a very positive thing. Also, this second bullet's very important. Loan payments are not due to your lender until the earlier of 2 dates. First, when you receive a loan forgiveness decision from the SBA, they would pass it from the SBA through your lender to you. The earlier of that date or 10 months from the end of your covered period. The reason I bring this up, we have received a number of reports of lenders calling their PPP borrowers and telling them they have to start making their payments immediately, and that is not correct. The Flexibility Act also extended some safe harbor dates to restore pay and headcount to pre-COVID levels to the end of this year, at least for now. So that's positive, and it buys you some more time to get things back to normal. Hopefully, if this resurgence doesn't shut us down again. Also, the Flex Act decreased the amount of your loan that must be spent on approved payroll items from 75% to 60%. But you still have to spend the majority of these funds on approved payroll line items. It is the Payroll Protection Program, after all. Something else that you should know, I'm going to skip down to the bottom here. Recipients are now eligible for a separate employer payroll tax deferral program. The operative word here is deferral. These are amounts that you're still going to have to pay back, which puts additional emphasis on your ability to manage cash and to manage your calendar so you don't miss the payment. Payroll taxes are nothing to mess around with. There are personal liabilities associated with making payroll tax payments. There was ambiguity around how the 8 versus 24-week cover period works, and that's been clarified. It's still a little complex. Borrowers can apply for forgiveness before the end of their 24-week cover period. That is, if their bank is accepting applications for forgiveness. In the forgiveness application, you have to pick between either an 8-week or a 24-week covered period in the application. There's no middle ground. Where this comes into play, to the extent that you're filing early, before the end of 24 weeks, there could be the need to calculate the impact of wage rate reductions on employees and to reduce the amount of your forgiveness associated with that. The wage reduction calculation in this application assumes the full amount of your cover period, and in this case, 24 weeks. The second bullet on this slide is very important. To the extent that you were contemplating a sale of your business and you're selling more or equal to or more of 50% of your assets or your equity stake, there are some restrictions. The fact is the SBA is your ultimate creditor. Your loan is with your bank, but the SBA is guaranteeing the loan, so they ultimately are the creditors here, and will put some restrictions on a transaction of this nature. First, you have to have filed for forgiveness with the SBA with all the supporting documentation, and your PPP lender must establish an escrow account equal to the amount of the outstanding balance of the loan. This last bullet could be a poison pill to getting some deals done in the near term. I'm going to go to the last bullet on this slide. On some of the forgiveness applications, you're going to see an expiration date in the corner. 10/31, and actually I saw 11/30 this last few days. Know that this does not apply to you. This is one federal employee talking to another federal employee. And all this did was create an immense confusion out there that these applications were going to expire. They don't. There are 3 different application forms that you might use to file for forgiveness on your PPP loan. I'm going to go through the 3. The first, Form 3508, is the revised forgiveness application form. It was published and then republished on June 16th. You're going to hear that June 16th date a few times here in my presentation. The Form 3508 was updated to reflect some of the terms and conditions that came out in the Flexibility Act on June 5th. It could be significantly more favorable to use this form to borrowers than the original version. There's more work potentially involved, especially if you have a lot of employees. The second form, close on the heels of 3508, was 3508EZ. This can be used by 2 different constituencies. First, Schedule C borrowers who did not claim any employees, or borrowers that did not reduce wages more than 25%, and this is wage rates more than 25%, for any individual employees, and either A or B. A, did not reduce the number of employees or average hours paid to employees between the first of the year and the end of your covered period, or claim the inability to operate at the same level of business versus pre-COVID due to compliance with federal, state, and local rules, regulations, and laws associated with COVID-19. By virtue of the name, this form is somewhat simpler to complete versus 3508. However, all the supporting data is still required. And by the way, you have to store that data for up to 6 years. The third form, published about 5 weeks ago, is Form 3508S. These are for loans less than $50,000. This is that slightly more than 2/3 of the PPP loan universe. To the extent that you can use this form, you will have no reduction to the amount of your forgiveness due to reduction in employee count or wage rates. You still have to create documentation and the supporting payroll data, especially, and you have to submit that. To the extent that you have affiliate companies, let's say that you're owned by a private equity firm or a common owner, and you have affiliate companies who also have PPP loans, you may not be able to use this, this form if all of your affiliates together and you have loans totaling more than $2 million. Let's talk about the calculation of forgiveness and that versus a reduction in headcount or wage rates. You might remember that the original legislation in the CARES Act indicated that a reduction in headcount should result in a pro rata reduction in how much of your loan is forgiven. As of June 16th, that changed. Forgiveness at that point became dependent on 3 things: the amount of your loan, the amount that you've spent in approved expense items during the term of your cover period, and finally, the amount of your reduction in headcount or wage rates during the cover period. Now, this communication of these changes in the rules did not come in the normal manner through frequently asked questions or interim final rules. They were just included in the forgiveness application and the attached instructions. So no, for the amount of forgiveness, the operative document became, on June 16th, Form 3508. Let's go through some conceptual, how the calculation of forgiveness happens conceptually. First, you take spending on approved expenses during your cover period: payroll, utilities, rent, and mortgage interest on secured debt. At least 60% of your spend must be on these approved payroll line items. That's critical. You don't want to break that rule. You can spend up to 100% of your loan on these approved payroll line items. What they're looking for is to protect payroll. The next line is very important. As of June 16th, the changes said there was no limit on how much of this spending on approved expenses you can incur during the cover period. You can spend far and away more than the amount of your loan. So you've got expenses now. There's a potential, to the extent that you have a wage rate reduction that's still in place, and we'll go through the rules on that. Let's take the expenses, and from that you take this wage rate reduction. The result, we'll call it item B, as in Baker. Then you calculate what's called their FTE reduction quotient. Let's say you start with 100 employees, and during the cover period, you are down to 80 employees. Your FTE reduction quotient is 80 over 100, 80%. You multiply that 80% times that item B that we calculated above, and the result is called, SBA term, not mine, the modified total. As long as you follow the payroll 60% spending rule, your forgiveness should be the lesser of the modified total or your loan amount. And again, I say should be. All of this is pending a potential review by the SBA, Treasury, or your lender. Let's look at a quick example. Let's say that you have $1 million PPP loan and you're spending on approved expenses during your cover period, less the impact of wage reduction, nets out to $1.5 million. You have spent significantly more than the amount of your PPP loan. Your FTE reduction quotient, much as we just described in the last slide, is 80% in this example. So your modified total is 80% times $1.5 million. That equals $1,200,000. Let's move down the page then. Your forgiveness is the lesser of the loan amount of $1 million or your modified total $1.2 million, as long as you've spent at least 60% of your costs on these approved payroll expenses. So the lesser of $1 million loan versus $1.2 million modified total is your full loan amount, $1 million. You have received full forgiveness on your loan, despite the fact that you're down in FTE count and you're down in wage rates. I can tell you that this new application for forgiveness published on June 16th created confusion. There was no further guidance since then from the federal government on whether the rules are going to change back. So what are we dealing with now? We have an application set of rules that are in conflict with the actual legislation from Congress. So it could be possible, we don't know how likely, that Congress could come back and say, SBA, you stepped across the line here, and you need to change the rules back. We don't know if that's going to happen. Listen, it's been, what, 5 months since June 16th. So for them to do that, how many thousands of businesses have relied on this and made big business decisions as a result? So if those changes do happen, it could result in residual loans for borrowers they did not anticipate, where they have wage reductions and do not qualify for safe harbors. And I'll describe safe harbors in a moment. How do you calculate this wage rate reduction? Again, it's based on your wage rates, not on total wage dollars. You compare for every employee their wage rate pre-COVID for the first quarter of this year and versus their average wage rate during the covered period. To the extent that that difference is more than 25%, then you've got an issue that you've got to cope with, and you might have to reduce your forgiveness. The amount that you reduce the forgiveness would be based on the government spotting you the first 25%, let's say that that particular employee has a 35% reduction, it's that extra 10% below 25% that would count to reduce your forgiveness. However, number 5, there is a safe harbor. To the extent that you can return that employee's wage rate back to pre-COVID levels on or before 12/31, per the rules, then the forgiveness reduction for that employee goes away. This next slide, I'm not going to go through this. Sorry for the small numbers. This is an example of somebody making $25 an hour pre-COVID and then $15 during the cover period. And you'll go through this analysis for each and every employee and add up all of those that had more than 25% reduction in average wage rate. And you add up all of those, and that amount of your forgiveness can be reduced unless there's a safe harbor that gets applied. Let's talk about safe harbor. Safe harbor is a government term, and these are ways for you to reduce or eliminate the reduction in your forgiveness. The first one is if, to the extent that you had restrictions on reopening, either restrictions or are out and out that you were closed, either from the federal, the state, or the local governments, laws, rules, regulations, any of those apply here. Document, document, document. Act like you're preparing for a brief to a lawyer. The second and third items here relate to individual employee counts and how that applies to reduction, related to reduction in FTEs. The second is if you've had to furlough an employee and then later offered them a job back and they rejected it, you can omit their FTE count in your total reduction of headcount calculations. And that can happen all the way up to 12/31. The third, let's say that you lost an employer, had to furlough an employee with very specific qualifications or skills, and you can't find somebody like that before 12/31. You have to document your efforts to find those people, and to the extent that you can't hire that person before 12/31, their headcount is not counted in your FTE reduction calculation. And then finally, as I kind of touched on earlier, if you're able to return your headcount and wage rates to pre-COVID levels before 12/31, the reduction in forgiveness should go away. But document all of this. There are 2 other methods to reach full forgiveness outside of safe harbors. First is that revised forgiveness application we went through earlier that was published on June 16th. And then also, this is not called a safe harbor, it should be. To the extent that you had to terminate an employee for cause or had somebody leave voluntarily, their headcount is removed from your FTE reduction calculation. Document all of these. What if you have both PPP and emergency disaster EIDL loans? Well, there are rules you should be aware of. And the first one is you can have loans through both programs, but the second one is the key one I want to focus on here. You cannot use funds from the PPP program and the EIDL program for the same purpose at the same time. Let's say you're trying to make payroll and you have your PPP money separate from your EIDL money, and you pull money out of both accounts to make that payroll. Per the SBA rules, you have broken a rule. And the worst case scenario is if and when the SBA finds this through a review, they could come to you and say, you have to pay back your EIDL loan right now. That's kind of the worst case scenario. So important safety tip, try not to do this. They can just only get you in trouble. Also know that you might remember through the application process for EIDLs, the sweetener for pursuing those loans is that you could get an advance on the loan before you even got the loan approved, up to $10,000, depending on how many employees you have. To the extent that you received that EIDL advance, that amount will be reduced from the amount forgiven on your PPP loan. There is no way around this. And so for companies with both loans that had an advance on their EIDL loan, know that coming out after forgiveness, you're going to have a loan, residual loan from PPP that you have to pay back. Now, to the extent that you get your hands on this presentation, and by the way, this presentation will be made available to you upon request. In the appendix, there's some additional slides on EIDL's best practices and rules around what you can and cannot use them for. So I have gone through a lot of information quickly. I hope that made sense. It's now my pleasure and privilege to introduce you to Scott Lieback, our Senior Manager of Insurance, is going to be talking about the accounting side of these PPP loans.
All right, thanks, Mike. I want to move to the next page here. So currently there is no US GAAP for business entities that touches on specifically how to account for forgivable loans or government grants to businesses. So although the legal form of the PPP is in fact debt, there are certain circumstances in which business entities could account for it as a government grant. So we're going to talk through in the next few slides those two different alternatives between debt and government grant accounting. So this first slide here, if a business entity accounts for it as debt, pretty similar in terms of other debt, in terms of the initial recognition, that'll be a liability on the balance sheet and the related interest will be accrued. Any related financing costs will be shown as a discount to that debt and the financing costs amortized over the remaining life of the loan. This third point, the interest rate on these PPP loans is considerably less than market. So a question has come up as to, well, do these business entities, do they need to impute additional interest? The short answer is no. There's a caveat in accounting for interest that states that essentially if the interest rate is mandated by the government or established by the government or debt held with the government, that essentially that instrument is outside the scope of imputing interest. So then, how does this liability get released from the balance sheet and the timing of that? So essentially, when recorded as debt, it's going to be released from the balance sheet and then recognized as extinguishment of debt in the income statement at the time that the SBA confirms that it has in fact been forgiven. And then the last bullet point here, the mismatch of expenses and income. What we're getting at there is more as it relates to timing. So if the PPP is accounted as debt, the expenses will have been incurred in 2020, and then assuming it's not forgiven until 2021, that's when the income will be recognized through the income statement. So 2020 will have expenses, and then 2021, assuming that's when it was forgiven, will have the income piece. So just a heads up on potential timing there within the financial statements. Mike, you want to move next slide, please? So, you have kind of the debt piece, the route you can go down, and then there's also the in-substance grant route. I guess I would initially say that there are conditions as to being able to account for PPP as an in-substance grant. A little bit more of a hurdle to achieve than just accounting for it as debt. So we'll get into it in a little bit, but essentially, the business should be squared away with all the specific conditions in order to be able to account for it as a grant. In terms of the initial recognition, you're going to treat that as a deferred income liability. And then as you are incurring those expenses, you'll be releasing that liability that essentially nets the expense and income, pretty much net effect within the income statement. Those amounts that are released from the liability to the income statement can be recorded as other income, or they can also offset that expense category. One thing to note is that any amount that is spent on those non-eligible expenses should still be recorded as debt. And then again, just touching on these specific conditions in order to account for the PPP as an in-substance grant, that really all the requirements should be met on the loan application. Need to verify and support that necessity was needed for PPP, and then ultimately have reasonable assurance that your loan will in fact be forgiven. Reasonable assurance is kind of more of an international accounting standards term within US GAAP that is synonymous with probable. And so, businesses need to kind of ascertain as to if all the requirements have been met. And in the event that there's any uncertainty as to whether the amount will not be forgiven, then that's when, companies should account for the PPP as debt. Next slide, Mike. So just a few other considerations as it relates to PPP. Regardless of which method between debt or grant accounting, companies should disclose the methodology that they're using in the financial statements, and then also, if it's not clear on the face of the financial statements where where those amounts are recorded, that should be disclosed as well. One thing to note is that you cannot change methods. So whatever methodology you selected in 2020, that cannot change in the 2021 financial statements. Mike touched on this a little bit, but as in terms of just kind of getting organized and record keeping, kind of document, have all of that squared away. SBA will be reviewing loans over 2 million. And then just the last point here to make is that for bank covenants, that this might be something to get ahead of with your lender, that if the PPP is accounted for as a loan, what's the impact of that on debt to equity, debt service, any current ratios that you may have. So just something to think through with your lender. So I know we went through that quickly. Happy to answer any questions in the Q&A portion, but with that, going to turn it over to Jesse to talk through the tax implications.
Thanks, Scott. So we'll wrap up here with any income tax consequences from these PPP loans. So as part of the program, the government came out and said, when forgiveness occurs, we're not going to include that forgiveness in taxable income. Typically, when debt is forgiven, you have to recognize cancellation of debt income. However, that was, very unique in this program that you don't have to include it. However, the IRS then came out with a notice 2020-32 saying that the expenses associated with the loan are not going to be deductible. So, which is typical if you have a non-deductible income item and and an expense that corresponds, it would then be treated as a non-deductible expense. Sorry, not includable income and non-deductible expense. So that's typically how the IRS does match those two items. However, it wasn't Congress's intent for those expenses to be forgiven, because essentially what it did is then negated the benefit of the exclusion of COD income on that forgiveness. So we're waiting to see if and when the next COVID package comes out, if they're going to clarify that. But for now, we have to assume that those expenses are in fact going to be treated as non-deductible for income tax purposes. And so the big question around the non-deductibility of the expenses is whether or not that is going to occur in 2020 when you incurred those expenses, or if it's going to instead, those expenses would become non-deductible in 2021 when the forgiveness occurs and when the non-recognition of that COD income would occur. So it's still up in the air to where that's going to land. So just something to keep in mind as you're planning for year end for 2020, and also thinking of tax planning for 2021. It is a big question mark that we need to just keep in mind. And then, as many of you are aware, the state law is different. And so, in Oregon, we conform to federal tax guidance. But there are a lot of non-conforming states that are going to treat this cancellation of debt income differently. And, you know, for example, California has come out and said that they, you know, they're going to match federal in that they're going to exclude the COD income, and they will also have non-deductible. They'll treat those expenses associated with the loan as non-deductible to the extent that a company has received forgiveness on those. Some other states have, you know, not provided separate legislation yet, you know, for these specific expenses, and so, and or the cancellation of debt income. So when they're in those situations where no separate guidance has come out, you know, just the typical treating that cancellation of debt income as includable for that state taxable income would be appropriate. Again, you know, I think the states are going to be coming out with additional guidance as the IRS finalizes some of these outstanding questions. So we'll just have to be waiting on that. You know, there are also some non-income based tax. You know, here in Oregon, we have the Oregon Corporate Activity Tax, and the you know, Oregon has come out and said that federal assistance associated with the CARES Act is not included as commercial activity and not subject to the CAT tax. So that is good news. You don't have to include that the loan forgiveness in your gross receipts for purposes of the CAT tax. And also Oregon did say that any expenses you incur related to this loan, the PPP loan, are includable in that deduction calculation. So they have already come out and said, you know, we're going to, you know, follow the intent of Congress, and we're going to allow you to take those deductions for purposes of calculating your allowable deductions against the gross receipts for purposes of the CAT tax. Texas, on the other hand, they will have you include the COD income in gross receipts for purposes of the franchise tax. So, you know, just to keep in mind when you get to filing your tax returns next year, that each state is going to have different rules and regarding the PPP loan forgiveness and the associated expenses and their deductibility. So it will be something you'll want to make sure you're touching base with your tax advisor on when we get there. And then we'll move to the next slide. There were some other programs that I wanted to touch on that came out with the CARES Act or with the Family First, and just wanted to touch on the impact of the PPP process or forgiveness on the other incentives. And so the first being there was an employee retention credit, and it was for employers who had their business partially or fully suspended due to emergency orders from local government authorities limiting, you know, business or travel. And there's some rules, but essentially what they came out and said was that you can't take advantage of this employee retention credit and the PPP loan forgiveness process. So just to keep that in mind. Then there were also two other there's the paid family leave credit and the sick leave credit. And both of those have different rules, you know, associated with having to take care of family members that were impacted by COVID, or, you know, or having to care for your child. And again, they came out and said you can't take advantage of both these credits and the PPP loan forgiveness on the same payroll expenses. So I think that about wraps it up for us. I've seen a couple questions come through the chat box, and here, you know, this is our contact information. As Carrie mentioned, or as Mike mentioned, we'll be happy to send out our slide deck to anyone who's interested, or we can send it out, you know, based on the attendee list that we have. So at this time, I'll pass it back to Carrie, and I think we'll go through. We're happy to go through any Q&A.
Great. Thank you. Thank you so much. That was very, very helpful. We do have a few questions that have come in. The first one I think you did ultimately get to, Mike, but I just want if you could please reiterate. Can you spend 100% on payroll and get a full deduction?
Yes, you can spend as much as your loan and even more on approved payroll expenses. And it's important that you understand that certain payroll expenses, such as payroll taxes, are not included in your ask, but at least 60%, all the way up to the full amount of your loan and beyond, can be spent on these payroll approved payroll expenses.
Okay, great. Another question that came in is, you had mentioned that there was $134 billion that hadn't yet been allocated. So what is going to happen to these funds? Are they going to hopefully be rolled over into a new CARES Act, or what? Or does this just go back to the government?
Well, that's a great question that nobody knows the answer to. Now that the election is I guess done, those dollars became locked up as of August 8th, and there's been a fight over what to do with those dollars, whether to roll them into a new program of different forms. And at this point, I can tell you, until the election was over, we have a contact who was there at the table with Congress negotiating the terms of any new legislation. And he said it was, he said the mood was terrible between the two sides. I'm not pointing a finger at either side. It was very, very tough. And there was nothing that was going to get done in the near term. Now that the election's over, we don't know whether additional legislation is pending or not. And if there is, then in theory, this additional money could get rolled into that. It really depends on negotiations. So that's my long answer to a short question.
Yeah, no, it sounds like a mess. Hopefully, given the fact that it's already out there, you know, I know that there's so many BIPOC and underrepresented companies that haven't received funding yet. So it would be nice to see them finally get the funding that they need. Okay, we have another question. If your PPP funds came into the same bank account as your revenue for the business, how do you show that the PPP funds were used for payroll versus the revenue that came into the same bank account around the same time? This question is in the chat. It's a little lengthy, so if you want to take a minute to read it there, but that is the question.
No, I pick up on it. Here's one response. Your banker should have been suggesting to you that you create a subledger at the very least, if not a separate bank account, to charge those dollars to for your PPP funds. Now the cow's out of the barn. So what I would suggest is you go back and create a subledger for the PPP money coming in and the approved expenses being charged to that amount, so that you have a separate tally on approved, you know, the money coming in and the approved expenses coming out, so that if and when, depending on how much of a loan you have, if and when a review would occur, you're prepared for that reviewer. And they will appreciate the fact that you're organized, but you're going to need to have that kind of analysis anyway. It's something you should be doing.
Okay, great. Thank you. Here's another question. When does the covered period of 24 weeks begin?
The day you get your first funding from the government, the day it hits your bank account.
Got it. Okay. Can an S Corp owner or employee count owner's draw compensation towards 60% payroll?
It can. However, there are limits. And so there are different limits depending on whether you're a C Corp, an S Corp, an LLC. So what I would suggest, and I don't have those specific rules for S Corp in front of me, but if you pull that up on Google, you should be able to find out the maximum that you can take as an S Corp owner toward your forgiveness calculation. It will depend on, again, on whether you're an S Corp or C Corp, but second, how much you made in 2019 during certain periods. If you have problems finding it, call me and we'll run this down for you.
Great, thank you. So another question that came in is, you had mentioned that there are several of the financial institutions that haven't opened up their forgiveness applications. Why is that? And when do the applications have to be turned in? And is there a sense that they're going to turn it on and turn it off really quickly before we have the chance to apply for the forgiveness?
So first, by when do you have to file forgiveness? You have up to 10 months from the last day of your covered period to file for forgiveness. So you have a long time. A number of banks have not turned on their portals yet to receive applications for forgiveness because number one, they're building their engine to go review all of these loans. Remember, there were 5.2 million loans written. That's a lot of loans. Second, they're hopeful that Congress comes back and says, okay, everybody below X dollars in their PPP loan, you don't need to be reviewed. You're just forgiven with a wave of the wand. And that will reduce significantly their workload. So what's happening with a number of lenders is that they're opening their portals, but they're not beginning the review process for the smaller loans. They're starting with the big loans first, and up to $10 million, right? So they're starting there in the hope they're going to not have to review all these smaller loans. So those are a couple reasons. There are a couple of more, but more internal operations of these banks. PPP really cratered the operational back office for many lenders, many SBA lenders. So they're trying to adjust and thrive in what is a very difficult situation for them. So.
Yeah, no, I've heard from a bunch of our members, it took so long, for them to get the PPP loans, but at the same time, they could tell from the lenders, right? The lenders were trying as best that they could to get to them, but it was just hard to get their attention because they were so bogged down.
Yes.
Okay, we've got another one here. Is it worth accruing immaterial interest on a loan that is expected to be fully forgiven? Beyond tax impacts, will authorities look for it? And that one is also in the chat. You want to take that one, Scott?
I think, it might depend a little bit on the dollar amount that's at play, right? And in relation to the financial statements as a whole. I get where the question is coming from, right? 1% on your outstanding balance might not be overly significant to the financial statements. Qualitatively, it might look a little bit funky just to not have any interest expense related to a debt instrument, but that might be something to discuss with their accountant or the users of the financial statements as to what is deemed to be significant. So I know that's not a.
Uh-oh.
Looks like Mike got froze, or Scott got frozen up.
At least he's smiling.
Yeah, it's a good picture of him, actually. Okay. A question that I have actually is, do you have any insight on what could be different if there is another CARES package passed within the next few months that we should, and I know you touched on a little bit about this, about record keeping and whatnot, but do you have any maybe insight on what the new CARES Act could look like, if there is one?
This is Mike. A couple of things. Since March, our our inside person that we've been working with. We've been feeding ideas and changes, some of which showed up in the Flexibility Act, and they were receiving this from a variety of sources, including us. So there have been other ideas floated, and this has been the source of contention between the two parties at the table. So the answer is we don't know. And will they create a second PPP to allow borrowers to go back for a second tranche of capital to keep them alive? You know, that's ultimately what people are looking for. However, there's been a lot of hard feelings about bigger borrowers, bigger companies borrowing PPP loans. And it is very possible, I don't know how likely, that they will limit the size of the business that's allowed to go back for a second PPP loan. And also public companies, whether you're big or small, there was a lot of heartburn over the fact that some public companies were borrowing PPP loans. But you know, I'm a former CFO. Sometimes public companies need capital too, and they can't get them from the public markets. So it's going to be interesting. I'm not answering your question because there is no one right answer yet. And by the way, if you know, let me know. Okay.
I don't know either. I do know that I do talk to a lot of financial institutions that are hoping for a little bit of administration relief if in fact there is another CARES Act passed. And I didn't really actually think about it from the application forgiveness point of view, but I think that they're probably hoping for some relief there as well.
That's right.
So those are all the questions that I see in the chat and in the Q&A. So last call. Yes, this presentation will be available to view at a later date. You can check that out at oregon.ti.org, and it'll be on our COVID recovery page. So we will make sure and have this video along with the presentation that our panelists went through today. So last call on questions. Okay, and Mike, if I could just get you to turn back the screen share to me, and I will wrap us up here. All right, so again, a huge thank you to Scott, Jesse, and Mike. I found this information to be very valuable, and I'm sure the attendees did as well. We have several events actually coming up before the end of the year, so I encourage you to go to our website, oregon.ti.org, but two that I will point out. Tomorrow we have Pitch Club, and Pitch Club is a really awesome place, a safe place for entrepreneurs to come and practice their pitch in front of their peers and also investors. You'll get some really great feedback on how to improve your pitch. So I encourage you all to attend that. And then we have our largest event of the year, which is Pitch Oregon. Obviously, both of these events will be taking place virtually. We've got 10 amazing companies presenting on December 1st from 5:30 to 8:30. They will be pitching for a prize package of $5,000. So please tune into that as well. And again, all of our events can be found on oregon.ti.org. And then finally, again, please take a look at the folks that are on the screen that support TI Oregon. Without these companies' support, we just wouldn't be able to put on events like this. And a special shout out again to Moss Adams for giving us their time today and the value information that they shared. We will continue to do a few, I don't know how long we're going to be doing this COVID recovery series, but we're going to be here till as long as we need to be. So tune into that. I believe the next one that we have will be in January. So with all of that, thank you everybody for attending. Again, thank you to Moss Adams, and we'll talk to you all soon. Thank you.